There is a visceral reaction to watching a stock price go strictly vertical. It triggers a primal fear of buying at the top. But the high tight flag pattern thrives on that exact velocity. A stock doubles in price in under 2 months, then pauses briefly in a tight consolidation phase. Traditional trading psychology dictates that buying into a near vertical chart is reckless chasing. It feels inherently dangerous. A comprehensive analysis of over 300 sampled market setups proves that fear is mathematically misplaced. This dashboard displays the core statistics from Table 22.2. In a bull market, this specific setup carries a 0% break-even failure rate, while yielding an average rise of 69%. We will chronologically deconstruct this anomaly using quantitative data, mapping exactly how to identify it, when to enter the trade, and manage the extreme velocity. Capturing pure alpha requires abandoning emotional biases and executing entirely on empirical probabilities. For decades, traders relied on William O'Neill's strict geometric criteria to identify this setup. Those classic rules demanded an exact time frame for the initial run and a consolidation phase that retraced no more than 20% of the price. This is the chart for Diana Corporation, demonstrating a pattern that aligns perfectly with strict rules. From the low point at 14, the stock skyrockets to 30.75 in under 2 months, checking every box of the rigid criteria. However, applying those rigid constraints filters out over 90% of highly profitable setups. The data reveals a looser criteria. You look for the raw magnitude of a near 100% price surge, followed by a visibly apparent consolidation area, regardless of exact geometric proportions. This chart for Amdahl Corporation violates almost all strict orthodox rules. The stock rises 95%, then descends 22% over 38 days. It fails the strict test, but passes the empirical one, resulting in a highly profitable breakout. Identifying these setups is an exercise in recognizing raw momentum footprints, not geometric perfection. During this phase, the pattern rarely resembles a neat, traditional pennant. You will typically see an irregular downward spike or a messy horizontal drift. The single most critical internal metric to validate the setup is volume. The volume trend must be visibly receding as the price consolidates. This split-screen visualization of Table 22.7 contrasts the outcomes. A falling volume trend, indicating supply is drying up, yields an average 71% performance gain. Rising volume, where supply floods the market, severely degrades the upside. Beyond volume, the physical dimensions of the flag dictate the probability of success. The statistical findings on pattern size run entirely counter to standard charting logic. According to Table 22.6 metrics mapped here, consolidations that are physically short in height and narrow in duration significantly outperform tall or wide patterns. The ideal window for this consolidation is incredibly brief. On average, the most successful patterns complete their pause in just over 2 weeks. A valid setup represents a brief, low-volume pause. It proves that the market is resting, not reversing. Because this is a pure momentum anomaly, relying on manual execution will result in missed entries. The breakout moves faster than human reaction time. We observe a flawless mechanical entry setup on the Fairchild Corporation chart. The correct protocol is to place an automated buy-stop order slightly above the flag's upper trend line. When the price pierces the line, the system triggers instantly. Once live, you calculate a mathematical profit target using the measure rule. You measure the distance of the initial price surge, cut that exact distance in half, and project the new distance upward, starting from the lowest price point of the flag. This target requires extreme time sensitivity. The velocity of the initial breakout does not last. This distribution curve of Table 22.5 data maps the rapid decay of momentum. Half of all these setups reach their ultimate high in just 14 to 21 days. Trading this anomaly requires pre-planned, automated execution. Human hesitation will cost you the alpha. When momentum breaks down, it fails rapidly. You must understand the dark side of this anomaly. The absolute invalidation rule is mechanical. If the price closes below the bottom of the flag pattern, the setup is dead. Exit the position immediately. This chart for Tesoro Petroleum illustrates a failed pattern caused by a structural friction known as a throwback. A throwback occurs when the stock breaks out, but loses momentum and meanders back down to the original breakout price line. The statistical damage of a throwback is severe. Based on Table 22.4, the presence of a throwback slashes the average expected rise from 100% down to 49%. To survive these sudden momentum collapses, you must implement a trailing mental stop. As the stock achieves new highs, you strictly trail your stop-loss order just below the prior minor lows, methodically locking in capital. Rigid, emotionless risk management is mathematically necessary. Once the trend finally ends, the price will suffer an average decline of 35%. The ideal environment for this anomaly is specific, a pure bull market featuring a violent initial price run of at least 90%. Internally, the setup demands a physically short, narrow consolidation paired with strictly receding volume. Execution must be flawless. Use automated buy stops to catch clean breakouts with zero throwback friction. The entire life cycle of this trade plays out in a matter of weeks. It requires intense focus and precise measurement. True profitable edges in the market are found by trading the statistics, not the hype of traditional charting. Market anomalies like the high tight flag fiercely reward the disciplined and ruthlessly punish the hesitant.